Non-qualified stock options have two different events that trigger the taxes. The first is when you exercise the stock, and the second is when you sell the stock. When you exercise a non-qualified stock option, the difference between the strike price and the fair market value of the stock on the day of exercise is considered to be income. Now, what is strike price? Strike price is the price that's predetermined by your company to be the price where you can buy the stock. And this is something you'd get from the grant agreement as well. And the fair market value is basically the price of the stock. So for a public company, it's basically the price that the stock is trading at. And then for a private company, it is what is called a 409A price, which your company should be able to provide. 409A prices are refreshed every year, so you should make sure to get the most recent 409A price from your company. So the difference between the strike price and the fair market value, either the price of the stock or the 409A price on the day of exercise, is considered to be income. So let's take an example. The strike price of a company stock you have is $1, and you sell the stock on a day when the fair market value is $6. Now the difference of $5 is considered to be income, and you pay income taxes on it. How much are income taxes? They can go from anywhere up to 37% in federal taxes, and then you also pay state taxes on top of it. So depending on which bracket you end up in, you will be paying that much for the income portion. So that's the first part. Also, it's important to remember that when you do exercise a stock option, your company will automatically withhold the standard 22% of the income for taxes. So you have to make sure that when you exercise a stock option, you have enough cash to pay both for the exercise as well as the taxes. And if the company is public, your company will allow you to sell enough shares to cover both of those expenses. However, if you don't sell the shares, or if your company is private or you cannot sell the shares, you will have to wire in the money to both pay for the exercise and also to pay for the taxes. So that's the first event that triggers taxes in a non-qualified stock option exercise.